There's a lot of confusing things out there about annuities. And that's probably because there's so many different types of annuities that really all have different bells and whistles and can be used in different situations. In this video, we're actually going to touch on some of the best uses for annuities, how they could be used in a financial plan, reasons why they can be a benefit, as well as some reasons why you might not want to use them in some cases. So check out this video as we discuss annuities. All right, so let's go ahead and jump into annuities. Again, as a financial advisor, this is an instrument that does come up that we do tend to use depending on what the clients need. And there is so many different types of annuities out there that sometimes can complement the market side of your portfolio or the real estate side of your portfolio. So we'll touch on that as well. The first one I want to talk about is the immediate annuity. Okay, it's really a simple form of what an annuity is. It's basically kind of what it sounds like. Essentially, let's say a client comes in and they have $500,000 that they want to maybe just take a payment out on. They want to move a chunk of money into the annuity company and say, give me a payment. Sometimes they're guaranteed for life. Sometimes they're guaranteed for 10 years, 20 years. It kind of depends on what the term is of that annuity. It can be a very attractive way, again, to guarantee a payment. As many of you guys know, there's not many forms out there or many investments out there that guarantee a payment. So immediate annuity is one of those situations you do see from time to time where a client, again, just wants to take a hunk of money, put it into something that's going to pay them cash flow for life. Okay, that's the immediate annuity. Very simple, no real big bells and whistles there. A lot of different carriers in the annuity side offer a form of that. The next one I wanted to talk to you about is a fixed annuity. I always joke this is basically like a CD on steroids, okay? What I mean by that is it's basically you put in $100,000 into this fixed annuity, and how it works is the insurance company is going to guarantee you a rate a lot like a CD. So except for it's a little bit more of a competitive rate. Typically it's more than the average CD. Let's say you're going to put $100,000 into this fixed annuity and they're going to guarantee you 3% for 3 years. What that means is 3% each year will be compounded to that $100,000 for 3 years. At the end of that 3 years, you have the option to leave it there and continue whatever the insurance company is paying at that time, or to take your money and move it elsewhere. Typically on those, there's typically no fees on those. They're a very low cost product. Again, very simple. It's not the sexiest, craziest investment out there. It's very simple. And again, it actually does have a lot of use. A client that comes in says, Logan, I have $100,000. I have my real estate. Maybe I have my stock market. I have income coming from pensions. And I got an extra $100,000 that I want to be safe, conservative with. I want a guaranteed return on, and I don't want to tie it up for too long. A fixed annuity can sometimes be a great choice for just simple, again, interest payments, as well as, like I said, a pretty competitive rate compared to what CDs and banking products are offering these days. So that's the fixed annuity. The next one I wanted to talk to you guys about is the variable annuity, okay? This is a tool that you hear about a lot. It has a lot of different uses. A lot of different companies do offer the variable annuity. And basically how it works essentially is it offers tax deferral. So a client puts in, $100,000 again in this example. It offers tax deferral as well, just like the other annuities, where anytime it makes any money earned is now tax deferred. You don't have to pay taxes on it on a year-end basis, similar to like a brokerage account. They tend to be a little more tax efficient for deferring taxes. And how it works is basically the insurance company in that one is going to invest your money, or you're going to help invest your money in the annuity into mutual funds. It's basically in the stock market. And when you hear variable, I always ask people, when you think of variable, what do you think of? Typically up and down, right? Like variable loans, that type of thing. When you hear variable, it typically means interest rates or returns are going to fluctuate. And that's exactly what the variable does. It's basically in the market, tracking mutual funds. It does carry risk depending on what risk profile you pick going into the variable annuity, as well as it can have other benefits like a death benefit. It could have an income rider that pays you out cash flow for life on those. So they do have different bells and whistles on those. The downside to the variable annuity is it does tend to have, when you hear annuities have high fees, almost 100% of the time you're hearing about a variable annuity. The average fees on those can get quite pricey. So you really want to make sure if you have a variable annuity that you really need it and it really is serving a specific purpose for what it is you're trying to accomplish. better than just being in the market. Because like I said, it's in the stock market, essentially tracking mutual funds. So you want to make sure it's something that's better than what you could be getting outside the annuity, just because of the cost of the internal annuity. So that's the variable annuity. Now I want to move on to the fixed index annuity. What I always tell people is it's basically the fixed annuity we talked about that's guaranteed, and the variable annuity, it's kind of like a hybrid of the two. How it works is it's a really good retirement savings vehicle for people that are looking for principal protection. Okay, a lot of people, and this might be like some of you guys in the video, again, maybe we have our stock market portfolio, we have a real estate holding, or we have other investments out there, but we have a chunk of money that we say, hey, Logan, you know what? The market's kind of all over the place. Real estate's kind of been doing this or that throughout the years. I want a safe place to put money, but I want a more competitive rate than maybe 1%, 2%, or 3%. I want to try to maybe participate in the upside of the market, but man, I sure don't like those down times of the market. That's exactly where the fixed index annuity can kind of find its home in your portfolio, because how a lot of those work essentially is you put $100,000 into the fixed index annuity. They sometimes have a time year on them, maybe 5 years or 10 years or whatever the tie-up period is. The benefit though is they give you the participation in the upside of some of the indexes. Some of the annuities out there track, let's say, the S&P. So for example, you get participation in whatever the upside is of the portfolio. Some of them have like a 50% participation rate. What that would mean is if the S&P went up 10%, you wouldn't get the 10, but you would get 5 in that example. The nice part about that is, right, that's a pretty good rate of return for a lot of people. The best part about it is now if you had 100,000 in there, it earned that 5%, let's say in that example, you now have 105,000. The next year, if the S&P drops 20%, you still have 105,000. Your principal is protected a lot like the fixed annuity, but the interest payments can be based off what the market's doing only on the upside. So they are a very attractive example for a lot of people. They've averaged, depending on which company and what specific annuity you're looking at, anywhere from 3 to 6% is typically what you can kind of expect on those. I have seen annuity companies that have a lot higher return than that and some lower, but that's about the average when you look across the industry. They also have an income rider on some companies. If you're looking for income, the fixed index annuity could be a good solution as well. How it works is basically it's a lot like the immediate annuity, where you could put money into this fixed index annuity and begin payments in 1 year or 5 years. It depends on the annuity, and they are now guaranteed for life. So it's a way to take a form of your retirement savings in a lot of cases, build a comprehensive plan with the market, real estate, other investments, as well as the fixed index annuity offers that competitive rate of return with cash flow for life if that's something that you choose to basically add on to the annuity depending on which one. So again, those are really the 4 types of annuities that you'll kind of see out there. And as you can see, they're not all the same. Some of them have better, some of you guys listening might say, man, that variable sounds pretty nice, or that fixed annuity sounds nice, or maybe the fixed index annuity. So you really want to take a look at all of the different annuities when it's time for you to decide if that's a good fit for you. I know when I'm meeting with clients that come into our office, what we do is we really want to make sure we're making sure that that annuity is a good fit for what the client's looking to do. It's a great, again, it's a great solution for a lot of people. I always joke, and you probably heard me say it on the show before, everyone will say, oh, that's a bad investment, or this is a bad investment. The funny part about investments is sometimes it could be a bad investment depending on what you wanted it to do. And sometimes it could be a great investment depending on what you wanted it to do. So it's all about finding that right investment out there for you, making sure it fits your risk. And we're all about making sure you understand the ins and outs of the investment before making any decisions. So I hope that was a really good overview for you guys on annuities. Again, we're going to do more on this channel throughout the years as far as plugging in different types of annuities like we just talked about, and maybe going more in depth on specific annuities. But I hope that was a great overview. If you haven't yet, go ahead and click subscribe, and we'll see you next week, again, coming out with videos each week. And if you hadn't yet, go ahead and check out our radio show that's actually on the YouTube format as well. Hope you guys have a great day. We'll see you soon.